Welcome to Elect to Succeed, Focused Investing When Politics Heat Up. I'm Phil Henry of Henry Wealth Management, and I got two rock stars here. I have Chris Cannon, who lives in this office with me because he runs RetireRight Financial Planning. I'm Henry Wealth Management. We cohabitate with the same broker dealer. We share ideas, we share clients, we share everything. We share meals.
Yeah. Yes.
We shared a golf game last week.
We did share a golf cart last week.
Good man. And Greg TRZASKI is visiting us from Symmetry. He's the senior regional director. And brother, we're glad you're in our region.
Absolutely.
Because you are amazing. We love you. And Symmetry Partners is a big part of Henry Wealth Management. So we're thrilled to have you here. Hey, we've done this before. You've seen all three of us. Mm-hmm. So we want to talk today about the political season. We have election coming up. You've heard that. And what does that do to the markets? What can we not control? What can we control? So we're going to dive into that momentarily. But first, you might have a question along the way. There's a dialogue box. Put your question in there. We'll try to get to it at the end. So with that in mind, let's start with a quiz. Chris, don't look at my sheet here.
No cheating.
When was the last time there was a presidential election rematch, and who were the candidates?
Got my finger on one, Eisenhower, because I only remember winners. I can't recall the other guy.
Okay, and what year was it?
56?
56?
Good, maybe.
We have the answer, Greg? Where's the answer on the screen?
Eisenhower and Stevenson.
1956. You got half. Hey,
right, you got the winner.
You did. I said I told you we're smart. All right, so that's one question. Now, no cheating. Now you can look ahead. Don't do this. All right, Greg. Who was the only president to lose his re-election campaign, run again, and win a second non-consecutive term? Who was it?
Just a wild guess here, Phil, but I'm going to go with Grover Cleveland. All right, one of my personal favorite presidents, the 22nd and the 24th president of the United States.
Okay, that's you nailed it. So hey, little quiz. You're here to get educated. We hope we help in that regard. But let's move forward. We want to talk about market returns and elections and what happens, and does the market go up or down, the volatility levels, what can we control, what can't we control? And let's just start with this slide here because we want to just come out of the gate and tell you this. It's difficult to identify systematic return patterns in election years. It really is. We'll get into that. But on the average, we can say this, make this statement. Returns have been positive in both election years and then the year following. So let's talk more about that. And Greg, start us off. Talk about what happens on average returns in an election year.
Yeah, absolutely. So, Phil, investors tend to get a little more anxious around election season. And, we do see during election years that there can be added volatility to capital markets. But over the long term, we really see that the data for stock market returns is very similar, both in election years and non-election years. And so what you're looking at this slide, the solid black line is your election year average by month for the S&P 500. The dotted red line is going to be your non-election year averages. And so ultimately what you're getting in an election year across the board since 1926, I believe, is 8% average annualized return. And that's happened in 75% of election years. Okay, we're going to get non-election years at 7.7%, 63% of the time.
Okay.
Right. And so when I read that, I say you're statistically, it's very, very close, both in election years and non-election years. The only thing we've seen in data is that you'll notice is that, in the first half of election years, we tend to see a flat or slightly negative market, very, very low return in the first few months of the year. And then we see that uptick in the second half of the year when the election's really getting hot, and we tend to see who's going to be, the potential winner of that presidential election. This year's been a little bit different. We actually saw very, very strong returns in the first half of the year. And, we wouldn't anticipate continued volatility, due to the election, amongst other reasons, the geopolitical climate and inflation, et cetera.
So they end up about the same place is the point. And certainly we're talking about long-term investment strategies here. So within a 12-month period, you shouldn't be in and out of the market, let alone in a longer term period. And like you said, you pretty much get to the same place, whether it's election year or non-election year, 8% or so averages in the S&P 500.
Right.
Now let's talk about Republicans, and Democrats. We got to do a little bit of this. Okay. Is there a difference on depending on who's in the White House, how the market performs? Can you show us the next slide?
Yeah. There's really no conclusive evidence that one party is going to, create an overall better return, for you. In fact, looking at this slide here, you'll see the four presidential terms that did have negative returns over the last 100 years was Herbert Hoover, Richard Nixon, and George Bush. And it really wasn't, it's very tough to tie the capital markets to just the president of the United States and just their party, right? Herbert Hoover, you had the Great Depression. There was a lot more going on that led to the Great Depression than how Herbert Hoover was running the country. Richard Nixon, you had, him taking currency and not tying it to gold anymore. You had record inflation in the United States. His presidential term started in the middle of a small recession. So again, some policy change, some not policy change, slightly negative over his term. It was actually very high in his first term and crashed, as the Watergate scandal kind of came about. And George Bush, through the 2008 financial crisis. Again, something that, an economic environment that was handed to him, not necessarily, caused by him.
But so there's a lot of good red years and a lot of good blue years on this chart. Some of the look like the red years might be a little higher in the high years, lower in the low years. What's the difference? They all end up about the same place over time is the point. Now let's talk about, Chris, let's turn to you. Please talk to us about the next slide, which is fixed income. And how does fixed income do based on who the president is?
Yes. So Phil, surprise, there's not much correlation. Good way to answer there. And we're obviously in a very unique environment here. Actually, fixed income has been a little challenged here recently with the rise in interest rates off of a historic low for a very extended period of time. But going forward, I think we're in a very unique environment where interest rates have stabilized. We've talked about potentially maybe them declining at some point. So that could present some really good opportunities for whoever the next president-elect to be would attach their name to some fixed income returns.
And we were all of the opinion at the beginning of this year that there might be 2 or 3 Fed rate cuts this year. As it turns out, we've had no Fed rate cuts, but maybe one at the end of the year. What's your opinion on that?
Yeah, they keep changing the forecast, right? I think there were 4 at one point, it's down to 1. And the question I get, and I've worked on a statistic here because I'm a statistic guy, could the Fed really cut rates with stocks at all-time highs? And the answer is yes. They've done it 20 times since 1980, and the S&P was higher a year later 20 times.
20 times,
Yeah,
20 for
so
20.
20 for 20. Yeah, pretty good statistic.
I like
So can they cut rates? Sure, absolutely. There's some things that they've been very vocal of what they're looking at. But yeah, we'll see.
But definitely, as you believe, as we move into 2025,
Correct.
The rate cuts will come.
Potentially. I mean, they're very data dependent. So it depends on what's coming in, how inflation's going, how jobs are going, how the economy's operating at that point in time.
And of course, that's something we can't control. We can't control.
That's correct.
Well, I guess we control who's in the White House. We all have a vote. We can't control things like interest rates and market volatility. We can't control those, but we can participate. Now, just give me this next slide, Chris, because I think this is a testament to 100 years worth of data.
Yeah.
Just under 100 years, and the growth. And we see blue Democratic president sees red Republicans, and really there's only a couple periods on here where we don't end up higher than where we started. Talk about those specific 2 times.
Yeah, I mean, it's 08, right? The financial crisis and then the Great Depression. Outside of that, the market's been a pretty good place to be for the last 100 years.
Okay, and even right now in the Biden presidency, there's still 6 months to go. He started a little higher, dipped down, now kind of back to where it was. So we don't know where that's going to end up. So you can't definitively say how the market will be like in his presidency.
Yeah, I mean, fun little statistic.
First term,
yeah, fun little statistic. The bear market ended 20 months ago, which was back in October 12th of 2022. So just be aware bull markets can last a lot longer than people think. And the average length of bull markets tends to run about 5 years. So this could be a young bull that we're experiencing at the moment.
And the key to this slide that you're looking at right now is buy and hold. Stay in the market. That doesn't mean you may change some securities within the market, but to get into stocks and then move the bonds and move the money market, move back to stocks, usually has not been a winning prescription.
Yeah, I've been doing this 2 decades. I've yet to find that crystal ball.
Right. So the buy and hold is what we believe in. Now, let's talk about this, Greg. Let's shift back to you. We educate, we talk, we try to motivate, and we still have a couple of clients. They're not on this call, but we have a couple of clients that might be very liberal, and they say, if Trump wins, I'm out. Take me out of the market. And we might have some very hardcore right people that say, hey, Biden wins, get me out. Let's talk about why that has not historically been the way to think. Help me with that.
Absolutely. And, the Trump winning the White House in 2016, I think showed, what the markets are capable of in a short period of time. I remember having the news on that night, and everybody thought that Hillary Clinton was going to be the winner, right? And then markets are a forward-looking mechanism. So markets have priced in Hillary Clinton primarily being the president of the United States. And, around 10, 11 o'clock, we start to see data coming in that's going to say, Trump has a chance to win here. Mm-hmm. And the Dow futures were down well over 1,000 points that night. And I remember my brother-in-law actually texting me in the middle of the night saying, should I move to cash in my 401k? And I said, move to cash. The money's gone right now. Moving to cash, you're just capturing that loss, right? And then the next day, markets went on to achieve a new record. I think they ended up the day maybe up over 1,000 points. Right. So, you had a 2,000 point swing in less than 24 hours, in about 12 hours, did the presidential election. Moral of the story is markets go up over time, regardless of the events that are happening, right? So markets corrected themselves after that short-term volatility test. So back to your question though, Phil, right here, we've actually broken down your returns going back to, this is investment of $10,000 dating back to January 3rd of 1950. So in the last 74 years, had you invested $10,000, if you only invested during Republican presidencies, you'd have a whopping $77,700. Okay, not bad. Your money grew. If you invested only during Democratic presidencies, that grew to $405,000. Right. So Democratic presidency since 1950 have done a little better. Had you invested the entire time, you'd have 3.15 million. Right.
Stay invested. Stay invested. Now, good. That was a good slide. Now, Chris, we have on this next slide 5 factors. 4 of them are out of our control.
Sure.
The 4th factor is in our control. Talk about these factors, these 5, how they drive markets, and then we'll focus on investor behavior. But talk a little about the fundamentals and corporate earnings and things of that nature.
Yeah, I mean, there's a lot more to the market than just the president, right? The president doesn't drive the election. And I'll add to Greg's comments, when you had that large drawdown immediately in the futures markets, the market doesn't like a lot of uncertainty. We experienced that when Trump was elected. We experienced that during the COVID crash really quickly. But once that certainty is kind of figured out, and we do have 2 candidates currently that are, we've had them both, so I think there's some level of certainty in terms of their policies and what they're going to do. Market seems to kind of hang in there pretty good, right? So as long as we don't have some crazy uncertain event, I think we'll be okay. But the factors that really drive the markets are economic fundamentals, right? What's going on with GDP, employment rates? Employment rates are low. Productivity is pretty high. At least here in this office, we're getting a lot done.
We do.
With the people we have here, right?
We're a microcosm of the U.S.
Yes, yeah, great. Corporate earnings, I think 80% of the companies that reported last quarter beat earnings. So companies are getting, they're profitable, they're lean, things are doing well. Monetary policy. Can't really control a lot going on there. It has to do with interest rates, quantitative easing. Again, we talked about where interest rates are going. They're being very data dependent. So we'll see. Investor behavior, things are pretty bullish right now. I think sentiment's pretty high on the street, which is good. Market's at all-time highs. End of the year after the election, I think that sentiment will be closer to 50%. Half people will be happy, half people are not going to be happy. That's only guarantee it's going to happen during an election, right? But technological innovation, you're seeing a lot of that right now. Fun fact, NVIDIA today became the world's largest company.
Wow.
Overtook Microsoft, right? And that has a lot to do with innovation. Companies are evolving, technology's helping, we're getting more efficient. The world's changing around us. And a lot of that's priced in on a continuous ongoing basis in the market.
But I believe the key on that slide is investor behavior. We can control that. Do we get nervous? Do we jump? Do we hang in there? Do we add more if we can when markets go down? It's all about our behavior and this having a plan. What's your RetireRight as a tagline? What do you say?
Life's easier with a plan.
Life's easier with a plan.
Yeah.
So plan and stick with the plan.
Yeah.
Now let's talk about in 2024, the I word, inflation, has been a big word, and that's how that's impacted markets. So where do we see inflation right now? Where do you see it going, and how's that going to impact markets?
Yeah, I mean, again, wish I had the crystal ball, and I'm still trying to figure out my own personal life whether my kids are eating more or groceries are costing more. I haven't figured that one out yet, but nonetheless, the bill's a little higher. But the economic data came in a little bit higher than expected earlier in the year, and most recently seemed to taper off and come down a little bit. So I think we're kind of in the wheelhouse where things are moderating to some degree. Wages are up. So it's an evolving landscape. But it's something that I know the Fed really wants to ensure that we don't have a double dip inflation, kind of like they had in the 70s, where they cut rates and then inflation rips back again. So they're being very certain on what they're doing with rates and how inflation is impacting us.
So they were raising rates to tap down inflation. Inflation has come down somewhat. That doesn't mean we hurry up and reduce rates. It's a balancing it.
Yeah, and again, for a large majority of our clients that own properties and have assets, it's been a pretty good period, right? Interest rates are a little higher. Savers get paid again for the first time in what feels like 20 years. Property values are up still. So it all hasn't been bad with higher rates.
Now, a couple more. Let's talk about, you just mentioned NVIDIA being the largest company in the world. So, Greg, NVIDIA is part of the Magnificent Seven. And the Mag 7, and if we take a look at these Mag 7, you'll get into who they are, but last year they crushed it. 2 years ago in 2022, total strikeout. They were terrible. So it went from worst to first, the Mag 7, and then this year it's kind of a mixed bag so far for the Mag. Overall market's up, but it's a mixed bag for the Mag 7. Tell our friends who the Mag 7 is and what's been going on with the Mag 7 lately.
Yeah, absolutely. Thanks, Phil. The Magnificent Seven are the 7 largest technology stocks that exist in the United States. Have really, you probably heard FanMag or other instances before that with your Facebook, Amazon, Netflix, Google. Everybody's got their own, acronym or name for what's going on. So the new one is Magnificent Seven. Top 7 tech stocks in the United States by market capitalization. And you're right? In 2022, they primarily drove the market.
And this is NVIDIA, it's Amazon, Google,
Microsoft, Apple, Tesla, those companies, right? And so they've been driving the market in 2022. Primarily all the gains in a client's portfolio were due to those 7 stocks.
23, not 22.
20, yes, correct.
22 was.
Right. All right. And then they had broad recovery in 2023. Again, it was driven by the market. 24, we've had kind of a mixed bag, right? And so what you can see on here, the larger the circle is, that's the market capitalization. So the largest circles are going to be the ones that we're referring to.
And this slide's a few weeks old, so the Microsoft circles on this slide is a little bigger than NVIDIA, but as of today, the NVIDIA circle got a little bigger.
Yeah, this is anyway. The end of Q1. But you'll notice, NVIDIA really crushing it this year. And, that has continued over the last 2 months to create the largest company in the world.
They've earned it. I mean, their earnings they're outperforming and exceeding expectations quarter to quarter. So this isn't just some, wild ride. They're proving it.
Yeah, absolutely. And, it's the hype has been there with the AI, and that's, obviously going to need chips to power that type of technology. So they've really, really surged this year. On the other hand, we've seen Tesla through the end of Q1 was down 28%, right? And that's been a pretty wild ride over the last few years. In fact, I believe it was in 2022, they dropped like 60%, roughly 60% in a calendar year, right? And so we do have a lot of clients that are asking us, hey, why am I not weighted in these companies more significantly? You know, why am I not capturing, why am I not seeing my portfolio up 82%, right? And, you know, there's a lot of concentration in the United States right now in those 7 stocks. And right, based on all the data and information that we have from the past, that tends to not continue, right? The returns you get as a company leading up to it becoming one of the top stocks in the S&P 500, their returns over the next 3, 5, 10 years tend to be pretty dismal, right? And so we want to make sure that we're well diversified, so that we're ready to capture it when, you know, stock markets work the way they should and we're seeing broad participation.
So we look at these 7 circles, NVIDIA way up this year, Meta way up, you know, Netflix up, Microsoft is up, Alphabet, Google's kind of flat, if you will, and then that's Alphabet, excuse me, Apple down, and then Tesla's that final circle way down. So like we said, mixed bag.
Yeah, let's not forget. I mean, Meta did go down almost 80% in the last couple of years. Google was down over 50% in 2022. Tesla's down 60% last year. So these companies go for rides.
So again, back to our strategy, and we'll talk about diversification in a moment. We don't believe it's prudent to hitch your horse to the Mag 7. Certainly in a broad-based portfolio, you will be well represented by the Mag 7, and we don't want to overdo it and hitch our entire wagon to that kind of portfolio unless you want to do this. We don't recommend that. Now, so what can we do, Chris, to control what we can control? It's called narrowing our focus, right? We want to narrow things that matter, but some things that matter we can't control. What can we control? We want to talk about that. So what would you tell your clients, our clients, what are the things they can focus on and control?
Yeah, the biggest thing, honestly, again, and I really thought very simply, you have an amazing tagline, as have we for some time. Life's easier with a plan, right? The time is right when it's right for you. Your plan is unique to you and the timing of your age, your income needs, and what's going on in your life at that point in time, right? You want to diversify and you want to have a plan in place, right? That plan will dictate where your assets should go, appropriate savings, and the appropriate spending, and making sure you have a well-diversified portfolio so that not everything goes up all at once, because that tends to go down all at once.
And that's the slide we have up now about being diversified. And take a look, pick an example here. For example, look at this green box. What's the green box? U.S. growth. In 23, it was top of the chart, right? What happened in 22?
Smoked.
Bottom of the chart. And in 21, it was up in the top third. So we go from, a playoff team to, the worst team on earth. They get the first round draft pick, and then they win the Super Bowl the next year. But that's so it'd be real easy to get in when they're hot. Oh, they're terrible. Get out. Then you get out right before they win the Super Bowl. We want to stay in all the colors, don't we? Not try to hyper focus on a couple of colors.
Yeah, I'm a very big statistics guy. I've looked at all different ones, by the worst from last year, by the best from last year, right? And nothing beats just having a well-diversified, balanced portfolio. I like staying in the comfort lane, right? Consistency is key. Alternating asset classes that don't all go up at the same time, that work cohesively and just provide a nice, consistent experience for you.
And that reminds me of a quote that you just said from Nick Murray. And why don't you read that quote to us? Nick Murray's quote.
The dominant determinant of real life long-term investment outcomes is not investment performance, it's investor behavior.
And that's back to what you can't control. You can't really control the investment market, but you can control your behavior. Get in, stay, and add to it systematically. And don't get too excited when markets are way up. Don't get too depressed when they get way down. Just live your life, and things will work out over the long term. So that's an important quote. And what about taxes, Chris? Tell us about taxes.
Yeah, I have an accounting background. I love taxes, right? I'm trying to avoid taxes to some degree within the rules. It's a big fun game. The avoidance of taxes is the only intellectual pursuit that carries any reward. If you save difference between long-term capital gains, short-term capital gains can be 10% or more. If you manage tax brackets, same difference. Brackets change significantly from 24 up to 32. So those are real returns.
And John Maynard Keyes is an economic legend, so that's his quote. Now I know I think there's a quote on the walls of Symmetry. I think somebody said something, and you guys framed it. And you talk about it all the time. What is this quote? This big quote at Symmetry Partners. What is it? What is it, Greg?
Absolutely. Well, like you said, we don't have any meetings at Symmetry without including this quote by one of our favorites, Mr. Phil Henry. Build a portfolio you can live with, and then live with it.
And if you live with it, up markets, down markets, just buy and hold, feed it, and let it work for you in the long term. And let's just close with one slide called "Stay the Course," because right now, we have a war in Ukraine, we have Israel-Hamas conflict, we have political things, and these events, these headlines, these noise there's always going to be something to make you scared. There's never a time there weren't headlines that could make you scared and walk away from your portfolio. But we believe, and look at these headlines, pull out a couple of these, Greg, if you will, and talk about it while the graph keeps going up and to the right with some bumps along the way, even though pick out a couple of those.
Absolutely. We have the Great Depression in the 1920s. You had the Korean War.
Take our word for it. We just lost that slide. Take our word for it.
But like you saw before, right? This was a very similar chart to what we saw with the presidents on it. There's always going to be negative news.
Right.
It's speaking of investor behavior. That's the way media works, right? Negative headlines draw in more attendance, right? It clicks with people, right? People are wired to be attached to more dramatic type things, right? And so that's why the news is so negative, right? But markets are resilient. They're forward looking. They've, historically always risen over time. One of my colleagues used to always say, volatility is the price you pay to capture the rewards that capital markets have to offer.
And let's just summarize, what we're here to talk about today. The title was Elect to Succeed, Focused Investing when Politics Heat Up. But whether it's politics heating up, headlines heating up, things heat up all the time, make your blood pressure go up, buy and hold, stay where you are. Look at this summary here. The parties occupied the White House and legislature are one of many variables that it can impact investments. In 2008, there was a financial crisis. In 2020, there was the pandemic that impacted Dems, it impacted Republicans. These things are out of our control. Your behavior is within your control. One of the most important takeaways is to don't worry about the short-term uncertainty. Focus on the long-term goals, as you said so eloquently. That's why we're doing this with a plan. And then finally, Chris and I serve as coaches.
Yeah.
We're here to coach, and I think hopefully you would say, yeah, you're good coaches. That's our job, is to get you where you need to be, buy and hold, get there, focus on the long-term goals. And we have great partners like Symmetry that help us with our clients' needs and investing needs and goals. So with that in mind, do we have questions from anybody? We don't have a question right now. That's okay. If you have a question, Phil@henrywealth.com. I will disseminate it and we'll answer it appropriately. You can tell your clients what your email address is.
Yeah, it's Chris@RetireRightFP.com.
So we appreciate everyone for joining us. This, of course, will be disseminated to people after the fact. So we're grateful. And Chris, you're amazing. Thank you.
Bill,
Greg from Connecticut, thanks for coming to see us. Thank you for joining. And when things heat up, stay cool, stay calm, buckle your seatbelt, enjoy the ride. Thank you for your time and for your business.